cartas. If you trust me and trust the computer, and bet only the numbers I tell you, if you follow the rules, if you are patient and think in terms of weeks, months, never tonight or even tomorrow, you will make a lot of money and live a life very few young people can afford.
That, of course, was Gonzalo Garcia Pelayo, and that was one of the scenes that inspired my Roulette Epiphany last November, nearly a year ago, just a few, maybe 2 weeks away, maybe 10 days. And I rewrote that advice he was giving to his family members who were going to be part of the professional roulette team, so that its terminology would better reflect my chosen activity, which is day trading. And so this is my daily affirmation. And I start every trading day by reading this out loud and then reading it silently to myself. And it goes like this. If you trust your edge and your method, and if you trade only the setups it gives you, if you follow the rules, if you are patient, and you think in terms of weeks and months, never today or even tomorrow, then you will make a lot of money. You will make a lot of money. And you will live a life very few can afford. And that's the stick of truth right there. That's why I've added this little Cartman wizard to the my affirmation screen, in addition to my little Bidvadian wizard of odds down there. The most important thing is you have to have a defined edge, a measurable edge based on real data, real back testing on your instrument, on data that was taken during the trading window that you are available to trade each and every day. So when it comes to fixed bar trading, for example, fixed bar intervals that I have found have an edge for me, at least currently, on the NQ, for example, might not work for you if what you're trading is the DAX or the British pound. I don't know. You have to do your own work. So everything that follows is just an explanation of what I do, and it is not in any way meant to be a recommendation that Monday morning you throw $100,000 of your life savings into a real account and start blasting trades based on this method. You first need to do the work for yourself. And that work needs to yield a defined trading plan where you know what conditions must be present in order for you to place an order to enter the market. And that trading plan must also have either a set stop loss or preferably a algorithm, so to speak, whereby you can define your risk and your take profit based on what price is actually doing leading up to your entry into the market. So I primarily trade two different methods: a fixed bar interval method and a reversal bar interval method. And what I'm going to do in this hopefully relatively brief video is explain or give examples or demonstrate how I trade these two methods. So the first chart we're going to look at is the money chart. Each of these dollar signs, or I should say, these dollar signs are each either under or over what I consider to be a signal bar. A signal bar is a bar that defines for the range of which defines for me an entry level, and the range of which defines for me where my stop loss will be placed and where my take profit will be placed relative to the range of that bar. Now, when you see this, my cursor, it's big, it's blue. So if I say this bar, look for where my cursor is. So this was a profitable fixed bar interval long. This bar was a signal for a profitable reversal bar short. This bar was a signal for a profitable fixed bar short. This bar was a signal for a profitable reversal bar long. And this bar was a signal for both a profitable fixed bar short as well as a profitable reversal bar short. And then this bar here was a signal for a profitable reversal bar long. Had this occurred at or before 3 p.m. in New York, this also could have been a signal for a reversal bar short. But as you can see, it actually closed when the market closed, the stock market, and therefore it would not have been a viable trade, just not enough time and enough volume to warrant the risk. So fixed bars are in the highlighted areas, and then there were 3 reversal bar trades. So let's go over first the fixed bars, then I'll explain how I define and identify reversal bar trades. So my fixed bar trades are based on particular intervals that occur each and every day. This first one is the 30-minute bar on the NQ that opens at 7:30 a.m. New York City time, closes at 8 a.m. New York City time. When this bar closes, I put a sell stop below the low to go short, a buy stop above the high to go long. Once triggered, in this case triggered long, my stop loss goes 1 tick below the low. My take profit is going to be the 61.8% extension of the range of my signal bar. And I quickly am able to identify that when trading with this tool. So the entry would have actually been 1 tick above this level at 232.5. There could have been slippage. Let's just assume the buy stop was filled at the stop order price. I would have placed a limit order to take profits at 56.75. Stop loss would have been 1 tick below the low, so it would have been 192.25. Very simple trading plan. That's why I recommend fixed bar trading plans for anyone who has yet to become a profitable trader. Because if you're still futzing with Ichimokus and Renkos and Heikin Ashis and moving averages and moving average bands, trend lines, chart patterns, you're very unlikely ever to achieve consistent results. Not like you can very quickly with a fixed bar method. So the next fixed bar interval that I would use for the NQ is the 30-minute bar that opens at 9 a.m., closes at 9:30 a.m., which of course corresponds to the open of the New York Stock Exchange. Buy stop above the high, sell stop below the low. And again, I'm using the range of the signal bar to identify my risk and my take profit. So in this case, my take profit would have been at 175 and a quarter for a profit of around $300. My initial risk would have been about $525. Now, some would look at this and say, oh, you left so much on the table. Yeah, but how do you know? Except after the fact, right? You don't know. You don't know until it's done. What I do know is based on the data, very strong probability that if the short's triggered, it's going to at least reach this target. If the long were triggered, it would at least reach the corresponding target above. So I can't base a trading plan on what might happen sometimes. I got to base it on what does happen enough times to give me an edge. Then the third fixed bar interval on this day is the bar that opens at 11 a.m. and closes at 11:30 a.m. New York City time. This bar corresponds to the close of the London Stock Exchange. And again, buy stop above the high, it wasn't triggered. Sell stop below the low, triggered short. Risk 1,000 to make 600. If the risk is too great, so if I don't want to risk $1,000 on one trade, say my max risk is $500. So what am I going to do? Well, I'm not going to trade a full-size NQ. I'm going to trade 5 MNQs, the micros. So I will adjust my risk by adjusting my position size. So again, fixed bar interval trade, fixed bar interval trade, fixed bar interval trade. These highlighted bars are always, every day, until the market changes. And it does occasionally change. So I've since last November, I have used 15-minute fixed bar intervals on the NQ. I have used 30-minute fixed bar intervals on the NQ. I have used 60-minute, 1 hour fixed bar intervals on the NQ. They always occur somewhere in this trading window, but they're not always exactly where these are. The market can change. It becomes more volatile or less volatile. And so that's why you should really focus on probably one instrument to start, maybe one or two. So for me, I primarily trade the NQ and gold. That's what I'm trading. So you should pick one because you need to learn the characteristics of your instrument because these are all different because they're traded by different institutional traders, different retail traders. They have different news cycles and all of that. So if you want to trade the ES, trade the ES. But I would stick to it and try to learn it as well as you want to know your instrument as well as you at least know, I don't know, your spouse, your significant other, that type of thing. Learn it. So now, reversal bars. I'm going to put arrows. So this was let's call it a bear reversal or a red reverse. No, let's call it bear because it implies we're going down. And then we had this bull reversal and this. So how about this? A short reversal bar and then a long reversal bar. So these are signal bars. Now, let me unsnap this so I can make a little bit of room. Okay. So what is a reversal bar? The most basic definition for me, and this is me, okay? They're not candlestick patterns. I don't care if it's a doji. I don't know. I don't even know what these terms are. I know there's like hangman or something like that. Tombstone, nothing like that. A reversal bar is simply this. When you have a bar that makes a higher high and a higher low than the prior bar, you're in an uptrend. You got that? When you get a bar that has made a higher high and a higher low than the previous bar, you are in an uptrend. That's how I define it for my trading plan. You may not agree with me, but you have to give me my given, right? I'm defining terms that I use that enable me to craft well-defined, precisely defined trade signals. Once I'm in an uptrend, the first bar that makes a lower low than the previous bar is a reversal bar. A variant of that short reversal bar would be any bar that makes a higher high than the previous bar and then closes below its midpoint. So you can rewind that last minute or so, get out pen and paper, type it, whatever you gotta do, but you should define those terms so that you can look at them for the rest of this video. So again, once a bar makes a higher low and a higher high than the previous bar, I'm in an uptrend. My next trade would be looking for a short reversal. So I'm looking here. We enter my trading window. So my trading window doesn't even start until here. I would have taken a fixed bar long. Profit would have been filled on this bar. This next bar makes a lower low than this bar. So this is now a bear reversal bar. I am going to place a sell stop below the low of this bar. My stop loss is going to be one tick above the high. My take profit will be the 61.8% extension. And for me, it'll be that level unless that 61.8, unless there are pivots between my entry and the target. In this case, there are no, the pivots are below. This is my target. So that's a short reversal bar trade. Now, once you have a bar that makes a lower high and a lower low than the previous bar, I now consider the market to be in a downtrend. I'm not drawing trend lines, not looking for moving average crosses. I don't care where the Ichimoku cloud might be. None of that stuff. Very simple. We're in a downtrend. This was a short, profitable, and another short fixed bar, profitable. Now, Remember, a reversal bar in a downtrend has two variants. The simplest version is the first bar that makes a lower low than the previous bar when the market had been in an uptrend. It's also a reversal bar if a bar makes, I should say, a level or higher high than the previous bar and then reverses down and closes below its midpoint. So notice there's no requirement in the second variant that the reversal bar trade below the low of the previous bar. If it makes an equal or higher high and then closes below its own midpoint, that's a reversal bar. So here we have a bar in a downtrend that made a lower low but reversed up, closing above its midpoint. This is a long reversal bar, even though it did not its high did not trade above the high of the prior bar. What makes it a reversal bar is the lower low and the closing above its own midpoint. So this would have been a reversal bar long entry, and everything applies. The stop loss would have been one tick below the low. The take profit would typically have been at 26,153.50. However, I would have placed the take profit at 26,149 and a quarter because the pivots were between the entry and my target, my planned target. And then finally, this bar, which was already a fixed bar signal bar, just by definition, the bar that opens at 11 a.m. New York time and closes at 11:30 New York time is a signal bar. Buy stop above the high, sell stop below the low. I don't care what color the bar is. I don't care if it's also a reversal bar. It's always bracket. Buy stop above to go long, sell stop below to go short. Buy stop above to go long, sell stop below to go short. Buy stop above to go long, sell stop below to go short. This bar also has the characteristic that it is not only a fixed bar interval signal bar for me, it also is a reversal bar signal bar. In this case, it did make a slightly higher high than the previous bar, and it closed below its own midpoint. So sell stop below because it's a reversal bar. The reason there would be a buy stop above this one is that it's also a fixed bar signal bar. On this bar, there would only have been a buy stop above because it is a long reversal bar looking for a long trigger. I would not put a sell stop here. On this bar, only a sell stop below the low. I would not put a buy stop to go long above the high of this bar. And then finally, we are in a downtrend. Okay, we have a bar that made a lower high and a lower low than this bar. So we are now in a downtrend looking for a potential long reversal bar. This bar, similarly to this bar, made a lower low than the previous bar. also made a higher high than the previous bar. So it became an outside bar, and it closed above its midpoint. And you can always check that using a fib tool, and you can see its close was at least 10 points above the midpoint. Doesn't have to be 10 points, just has to be above the midpoint for me. That's how I define it. And again, another profitable long. Unusual day to have had this number, profitable long, profitable short, would have added on this one, profitable short. This is if you trade it strictly. Profitable long, profitable short, profitable long. And then this is a reversal bar. Again, similar to this bar, made a higher high than the previous bar, lower low than the previous bar, closed below its midpoint. So it actually satisfied all three of the criteria I used to define a reversal bar. However, this close was the close of the stock market, and it was the close of the week. I'm not taking this trade. I typically will not act on a signal bar later than the bar that closes at 3 p.m. Eastern. And for anyone who knows me, my trading window really is typically here. I'm usually not even still trading at this point, so I'm not always taking these trades. So that defines it. I think you should be able to take what I just explained and replicate my trading plan. And what I would suggest to anyone for whom profitable trading has remained elusive, if you're treading water at break even, or worse, you're blowing accounts, you're blowing evaluations, you manage to pass an evaluation, and then a day later you blow your first funded account or your 200th funded account on day 1 or 2, then really give fixed bar or reversal bar trading a look. If you don't want to trade the NQ, that's fine. It works on any freely traded, highly liquid market. It'll perhaps require you identify a different bar interval. So maybe the 15-minute or the 60-minute, but the 30-minute might not have an edge for your market. I would really strongly advise you to stay away from anything less than a 15-minute bar for either of these types of trading methods. I know there's at least one person who posts to the Price Bob thread at Forex Factory who has been chasing 1-minute fixed bars and has not been successful. 1 minute is just probably not going to have the kind of edge that we need. 5-minute would probably be the minimum. I know the original Me Bob, of course, is based on a 5-minute ES interval. But again, my own back testing on various markets has indicated to me that so long as you aren't chasing the mythological 2-to-1, 3-to-1 reward to risk, if you're willing to base your take profit on what the market reasonably gives repeatedly on your instrument and your interval, that's where your edge will be. Kind of lost the train of my thought there, so I'm not sure that sentence made sense. But at any rate, that's it. You should, if trading isn't working for you, get away from the moving averages, get away from the funny bars like Renko and Hike and Ashi. And again, you can go to my Forex Factory history. I've done everything. I've played with all of that. And I'm telling you, consistency eluded me until the Roulette Epiphany opened my eyes to how I had been paying lip service to, for example, the Mark Douglas 20 trade exercise. And was paying lip service to having a systematic, rule-based trading plan. This works. Fixed bar interval trading is probably where anyone who has not yet achieved consistent profitability should start, and then reversal bar trading can be added in the future. However, if you define reversal bars and trends the way I just defined them for you, I think you could do a reversal bar method. The benefit of the fixed bar method is you know exactly what time you need to be prepared to enter your entry orders. You can really plan your life. You can really make that trading plan work with your lifestyle. So that's it. A little over 30 minutes, not bad. And again, just remember, if you have an edge, if you really do have an edge, and an edge is not market looked like it was going up, market looked like it was going down, market looked like it was going to reverse up, market looked like it was going to reverse down. The Ichimoku Kijinsen crossed over to 50-day moving, money flow. If your edge is actually when price does this, I should enter an order to go long. My take profit should be a multiple of the current range of some sort, and my risk should be the bottom of that signal bar, right? So if you have an edge, trust it, because if you trust your edge and your method, and again, the methods I use, I call fixed bar interval and reversal bar interval. Those are my methods. The edge goes beyond that in that you have to find the particular interval and the particular times of day where a breakout from the range during that interval on your chosen instrument is more likely to reach some defined take profit level before it reverses and takes out your stop loss. So I'm going to do one more thing before I finish this part. So this was an extraordinary day. The fixed bar and reversal bar methods could do no wrong. That is not typical. So the day before, this happened. So this was a reversal bar, a long reversal bar, made a lower low in the previous bar. Market was in a downtrend, closed above its midpoint. It had the virtue of also being a fixed bar interval. So buy stop above, sell stop below, buy stop was triggered, sell before it reached even the pivot, much less the 61.8, price reversed, crashed through to stop loss. And look, I came all the way down here, and the NQ can just be schizo some days. So the fixed bar method and the reversal bar method is not a holy grail in that they always win. They do not. But they do have an edge, a measurable edge that allows one to precisely define signals and precisely identify their take profit level and their stop loss. Not too many things on Forex Factory let you do that. So, again, I just didn't want anyone thinking, based on Friday's example, that this was somehow the Holy Grail. This is extraordinary to have everything work out as a profitable trade during one trading session. Typically doesn't happen, okay? So don't get all excited. I should have said this at the beginning, because I know probably 90% of the people who watched the beginning are no longer with us. But at any rate, if you trust your edge and your method, and if you trade only the setups it gives you, if you follow the rules, if you're patient, and you think in terms of weeks and months, never today or even tomorrow, don't worry about what happened today or tomorrow, or today, because that leads to FOMO and revenge trading. Today doesn't matter. The only thing that matters today is that you've trusted your edge and your method, and you traded only the setups it gave you. Because if you do all of that, you'll make a lot of money, and you will live a life very few can afford. Have a great day.